Hi everyone and welcome. I'm Mike Werner and today we're going to be taking a look at calculating standard cost variances. To get started with this, we're going to look at a very small company, one that's easy to visualize. The company that I'm using, a fictitious company, is a company that sells mailboxes, Treetop Mailbox Company. The company was founded by 3 college sophomores and they make wooden mailboxes that they sell for $10 each. They've rented a small garage for $200 a month. And the rent includes all utilities except the cost of electricity, which they have to pay themselves. They purchased some woodworking equipment at a cost of $900. They plan to use the equipment for 3 years. The residual value of the equipment after the 3 years they anticipate will be zero. So if we take the $900 cost minus the residual value of zero, divide by 36 months, we get depreciation of $25 per month on the equipment. Each of the 3 entrepreneurs plans to work at the company about 60 hours per month, and they will be making the mailboxes themselves. So 60 hours per month for each one of them. That's a total of 180 direct labor hours that we have to work with. They plan to pay themselves $10 per hour, and profits will be shared equally by the 3 owners. Their first month of operation, October 2019, went well. It went great. They made and sold 300 mailboxes for a sales revenue of $3,000. They had variable cost of $2,470, fixed cost of $225, so their profit was $305. The material cost was $600 for the wood. They're buying this 1/4 inch thick, 2 inch wide pine wood and fabricating the mailboxes out of that. They worked their 180 direct labor hours as planned at the $10 per hour, again as planned, for a total of $1,800. Their utilities, which was really electricity. The electricity was $40, and this is the electricity they used while they were open making the mailboxes. When they're closed, when they go home at night, they shut off all the lights and they use no electricity. It's just a garage, no need to have any electrical appliances running at night. The miscellaneous variable cost includes indirect material that they use to make the mailboxes, such as glue, small nails, and stain. And then the fixed cost would include the rent on the warehouse we mentioned earlier of $200 per month, and the depreciation on the production equipment, which is $25 per month. So there you have it, the breakdown of the costs for the company. Well, their second month of operations did not go as well. This is November of 2019. Oh my gosh, look at this. A loss of $303. And the question is, what caused this? What happened here? Obviously, they sold fewer mailboxes. They only sold 225 mailboxes, so their sales were way down. Look here. They also gave themselves a 50-cent per hour raise, so they did that. They used quite a bit of wood, $477 worth of wood. Utilities was a little bit high, and look at all of the supplies they used up to make these mailboxes. So what do we do to get things back under control? Well, we're going to use standard costing to help us determine what went wrong and what we can do to solve the problems. So in this video, we're going to calculate the standard cost variances. Now, to calculate the standard cost variances, we're going to need to know about their actual performance. So we're going to use the actual performance for November. And this statement gives us enough information. I might say, go ahead and take a screenshot of the statement so that you have it to refer to as we go through the example. Take a screenshot and print it out. You see we've got sales of 225 mailboxes at $10 each, 6,000 feet of wood for that amount. You can figure out the actual price paid per foot of wood if you want, although there's no need to do that, I don't think. And then you've got the amounts for the labor, the amount for the variable cost, the amount for the fixed cost. We pretty much have what we need with respect to actual amounts to calculate our standard cost variances. We're also going to need some standards. So here we have a list of the standards that they have developed. And what happened is the 3 entrepreneurs looked at their situation and developed these standards. In a real company, this would be quite an effort to develop standards, but in this video, we don't focus so much on determining the standards, but instead focus on calculating the variances. So we're going to assume that the employees looked at their situation and developed these reasonable standards for producing their products. And what they came up with is it should take about 21.6 feet of wood to manufacture each mailbox. And that allows for about a 35% waste factor for knots and imperfections in the wood. In the direct material, it's actually 70 cents per 8-foot length. And if you take the 70 cents per 8-foot length and divide it by 8 feet, you get a price per foot of 0.0875. And we don't want to round this to 9 cents per foot because they're going to be using thousands of feet of this wood. So instead, we're going to go with a $0.0875 per foot of wood. With respect to the direct labor efficiency standard, they have determined it takes about 36 minutes to make one of these mailboxes on average, which is 0.6 of an hour. So for each unit they produce, the efficiency standard is 0.6 hours or 36 minutes. The direct labor rate standard is $10 per hour. That's what they agreed to. That's what they plan to pay themselves. We also need this direct labor efficiency standard for the variable manufacturing overhead and fixed manufacturing overhead. So I've repeated it here 3 times. The variable manufacturing overhead per direct labor hour is 35 cents. So we've done some math, not included in this video, which renders 35 cents per hour as the standard variable manufacturing overhead rate. And then for fixed manufacturing overhead, the standard rate is $1.25 per direct labor hour. The company intends to produce 300 mailboxes during the month. So hopefully they'll be able to produce 300 mailboxes a month. Obviously in November, that didn't happen. They only made and sold 225. That's not so good. So we're going to have to factor that in as we calculate our variances. This information is going to be very important as we calculate our standard cost variances. So I might suggest that you take a screenshot and print it out so that you'll have it handy as we calculate the variances. So we have the standards, we've got the actual results, so it looks like we have what we need to go ahead and calculate the variances. As is the case with almost any mathematical operation, there are various ways to get to the right answer. In this video, we're going to use a very popular method, sometimes called the graphical approach, to get to our answers. It's a somewhat abstract way of calculating the variances, but it's quick to learn and something you should be able to remember if you have to calculate these variances in the future. So now we're going to take a look at the direct material variances. And the one we're going to start with is the direct material price variance. We're going to take a look at the amount that they actually paid, so actually paid, and we're going to compare that to the amount they should have paid. And we're going to base this on the amount of wood they actually purchased. We can look at the November income statement and we find that they actually purchased, and it happens that they actually used 6,000 feet. So they purchased and used 6,000 feet of wood, and the cost of the wood was a total of $477. They don't provide us with the cost per foot of the wood, but they do provide us with the actual amount paid for the wood. So that's all we really need. So we're going to look at the actual amount paid. So this is going to be the actual here. We could get it by taking the actual quantity of the wood purchased, and it's important to go with the amount purchased here, actual quantity purchased, because we're exploring the price variance, and it has to do with the amount purchased, not the amount used. So actual quantity purchased times the actual price of the wood, and what we come up with is it's 6,000 feet of wood times the actual price of, well, they never told us. We don't know that number. We could figure it out, but we don't need it. And the amount that they paid was the $477. So we got an actual amount paid for the wood of $477. So the question is, how much should they have paid for the wood? So if we take the actual quantity purchased again of 6,000, we can multiply it by the price per foot of the wood they should have paid. This, of course, is the direct material price standard, and the direct material price standard is 0.0875, so almost 9 cents per foot, 0.875 per foot. So we're going to multiply by the standard price. So we're going to take the 6,000 feet that they purchased, the actual purchase quantity, times the standard price of 0.0875. And when we multiply, we get $525. So they should have paid $525 for the wood. They actually paid $477. So the difference between these two amounts mathematically is $48. And since they paid less than at standard, this would be a favorable variance. So we compare the two amounts, and we get a $48 favorable variance. And this again is focusing on the price paid for the wood. So this is the direct material price variance. Now we need to move on to the direct material quantity variance. So to get this amount, what we're going to do is we're going to look at how much wood they used. So the actual quantity of wood used, so the actual quantity of the material that they used in production is the 6,000 pounds. Now for us, the amount purchased and the amount used in production, it's the same amount. It's the same amount. Oftentimes, though, the company will buy an amount of material and they won't use it all. So we got to be careful in that situation. For the price variance, we use the actual quantity purchased of the wood or the material. And for the quantity variance, sometimes called the efficiency variance, what we want to do is use the actual quantity used. And then we're going to assign a dollar amount to this. And you might think we would use the actual price. Since we know that now, we can calculate it and get it. But instead, what companies do is they use the standard price here, the standard price. And the reason they use the standard price is they don't want to blend in any benefit or detriment that came from the price variance into this next variance. You know, they want this to be pure, so they're going to base it on the standard price. So 6,000 feet that they actually used at standard is $525. So there we go. And we're going to compare that to the amount they should have used. We're going to compare that to the amount of wood they should have used at standard. So a quantity, maybe I should say quantity should have used times the standard price. And how we're going to get that is to use the standard quantity allowed for actual production. That's the standard quantity allowed for actual production, and that A stands for actual, standard quantity of material allowed for actual production times the standard price. And let's see, how many units did they make? Because we need the actual production. Looking here at the income statement, 225 mailboxes. They made 225 mailboxes. Okay, so the question is, how much wood should they have used to make the 225 mailboxes? So they made actual production is 225 times, we're going to have to multiply it by the quantity standard. And the quantity standard, let me get that. Here it is. Here's the quantity standard, direct material quantity standard. It takes 21.6 feet of wood per mailbox. Okay. So 21.6 feet, 21.6. We're going to multiply this by the standard price, which is the 0.0875 per foot. Now, 225 units times 21.6 feet per unit gives us 4,860 feet. And at standard, let's see, the standard price, 0.0875, multiplying, we get $425.25, $425.25. So this is the amount that they should have used to make the mailboxes. They should have used 4,860. They actually used 6,000, so they used a lot more wood. And then we multiply it by the standard price to sort of bring it to life with dollars and cents. And now we're going to take a look at the difference here. We're going to look at the difference. and we find out the difference is $99.75. $99.75. And is it favorable or unfavorable? Well, they should have used 4,860 feet of wood. They actually used 6,000 feet of wood, so this is definitely unfavorable. And we've assigned a dollar amount because most people are interested in dollars, not just how many pounds or board feet you've used or overused. And this would be the direct material quantity, sometimes called the efficiency variance. So there we go. So we've calculated the variances for direct material. We've got a favorable variance with respect to the price paid per foot of wood of $48. So whoever bought the wood, it's probably the purchasing agent for the company. It appears that they did pretty well price-wise. But then the amount of wood it took to make the mailboxes was pretty excessive. They used a lot more wood than we thought they should. It does beg the question, did they get a good deal on the wood because the wood was not as good? Maybe it had more defects, more knots in it, who knows? That's a possible explanation. But in the bottom line here, they have an unfavorable quantity variance of $99.75 and a favorable price variance of $48. Looking back at our income statement, one of the problems they have is that they've got an unfavorable direct material quantity variance. Let me make one correction here. I should have indicated that this is the actual quantity used times the standard price. I mentioned it was the standard price, but I forgot to indicate it. Another variance that could be helpful is the total direct material variance for standard costing, and that would be the difference between the actual direct material cost and the amount applied to production. You could also get it by adding the price variance and the quantity variance together, and when you do, in this case it's $51.75. This variance is called the direct material flexible budget variance, or it could be called the direct material spending variance. When the amount purchased is different from the amount used, this variance becomes a little bit convoluted, because if you get the difference between the actual and the applied to production, it will not equal the amount of your individual variances. But the variance can be helpful. It may be something that your professor requires, or your homework, or perhaps it might appear on an exam. Here the variances are again for direct material. Now let's take a look at the direct labor variances. So for direct labor, we're going to look at the rate, our labor rate, how much per hour we paid our employees. So we'll look at that. And we're also going to take a look at the efficiency of the direct labor in producing our products. So for the rate variance, sometimes called the price variance, what we're going to do is compare the actual cost, actual amount paid to what should have been paid. Maybe what we should have paid for this labor. So let's take a look here. Going back to the income statement, they worked 162 hours at a cost of $1,701, and lo and behold, they give us the actual labor rate of $10.50. So 162 hours at $10.50, or $1,701. To get the actual amount paid, we're going to take the actual hours worked times the actual rate. And so the actual hours worked were 162 hours times the actual rate. Sometimes the actual rate is not provided. They just give you the actual amount paid. But in this case, they did give us the $10.50 per direct labor hour. And when we multiply it, or we could actually get the amount off the income statement, it's a cost of $1,701. So that's how much they paid for the labor. The next thing we want to know is how much should they have paid for these 162 hours. So we're going to take the actual hours times the standard rate for labor. And if we take a look, we find that the direct labor rate standard is $10 per hour. So they should have paid $10 per hour. So let's go ahead and enter that. So we're going to take the 162 hours times they should have paid $10 per hour, not $10.50. So we multiply that out and we get $1,620. That's how much they should have paid. Uh-oh, looks like they overpaid a bit here. They overpaid by, just mathematically getting the difference. It's $81. And the actual side is higher than the standard side. So this is definitely unfavorable. This is unfavorable. And this is the direct labor rate variance. Direct labor rate variance. Now, to get the direct labor efficiency variance, what we're going to do is look at the actual number of hours worked at the standard price and compare that to the standard number of hours allowed for actual production times the standard price. In other words, how many hours should we have worked for our actual production? So if we, to get that amount, what we're going to do is take the standard hours allowed for actual production, this A is for actual production, times the standard rate. So recall that they produced 225 mailboxes, and according to this, the direct labor standard is 0.6 hours per unit. 0.6 hours per unit. So 225 times 0.6, and that will give us the number of hours they should have worked, and then we're going to multiply it by the standard labor rate of the $10. And so 225 times 6 gives us 135 hours. They should have only worked 135 hours times the $10 means that the labor should have cost us for this many units, for the 225 units, the labor should have cost $1,350. Oh, wow. If we compare the 1,350 to the actual, the number of hours they actually worked at standard, we have a variance of $270. $270. And they should have worked 135 hours. They worked a whopping 162 hours, and so this is definitely unfavorable. And this is the direct labor efficiency variance. Direct labor efficiency variance of 270, unfavorable. Another variance that could be helpful is the total variance for direct labor. In this case, the difference between the actual direct labor cost and the amount applied to production is $351. It's also the total of the direct labor rate variance and the direct labor efficiency variance of 81 plus 270 equals the $351. This variance is called the direct labor flexible budget variance, or it could be called the direct labor spending variance. Here's the direct labor variances in a little bit neater form. Okay, before we move on, I want to point out something about these variance calculations. If you'll recall, for direct material, we had actual quantity times the actual price, and then actual quantity times the standard price, then standard quantity allowed for actual production times the standard price. And then for direct labor, we had actual quantity times actual price, actual quantity times standard price, standard quantity allowed for actual production times the standard price. So for direct material, these were the calculations. For direct labor, oh, wait a minute, hold it, wait. It was an actual quantity. We changed the term quantity. Instead of a quantity of hours, we just said hours. So we used actual hours times, instead of actual price, we used actual rate. So it's basically the same thing, but we changed the names to protect the innocent. So actual hours times standard rate, and then standard hours allowed for actual production times the standard rate. Okay? It's the same, though. I mean, it's really the same. Actual hours times the actual rate, actual hours times the standard rate, standard hours allowed times the standard rate. And so these two calculations, except for the fact that we changed the names, they're pretty much the same. Then we're going to get into variable manufacturing overhead, and we will use actual hours times the actual rate, actual hours times the standard rate, and then standard hours allowed for actual production times the standard rate. So the calculations are identical to direct labor. So direct material and direct labor, the calculations are nearly identical, except we change the names. And then going from direct labor to variable overhead, the calculations are identical, except for, of course, in variable overhead, the rate we're using is for variable overhead, and for labor, we're using the rate for the labor. Otherwise, they're identical. So I want to point this out so that as you're studying this, as you're learning it, you do notice these parallels, which should make your studies a little easier. One other thing I want to point out is that it's quantity times price. Quantity times price. Quantity times price. You see, quantity times price, quantity times price, quantity times price. Just like if you were going to a hardware store, that's how they fill out the little sales ticket, quantity times price. And so that's pretty easy to remember. Another thing that you'll notice is we got actual, and then right here in the middle, here it is in the middle, we change to standard. You see there? See how it works? Actual, standard. Actual, standard. The same with variable overhead. And here, instead of with labor going quantity times price, we're hour times rate. Same with variable manufacturing overhead. So it should be easy to remember the format. Now I must point out when we get to fixed manufacturing overhead, we may have a little difficulty, because on this one you get actual hours times the actual rate, and then at this end you still have the standard hours allowed for actual production times the standard rate. But in the middle here, let me erase this, move this up just a little bit perhaps. In the middle, what we've got is budgeted fixed manufacturing overhead. Fixed manufacturing overhead. So you got to remember when you're doing the fixed manufacturing overhead variances, this middle value is going to be different. And if you use the same calculations that you've been using for these other ones, you're going to get not just one variance wrong, but two of them will be incorrect. So be sure that you compare actual fixed manufacturing overhead to budgeted fixed manufacturing overhead, and then budgeted fixed manufacturing overhead to the standard hours allowed times the standard rate, and you should be okay. So let's get back to the video, and we're moving on to variable manufacturing overhead. Okay, so as I just mentioned, for variable overhead, we're going to take the actual hours times the actual rate and compare that to the actual hours times the standard rate, and then compare that to the standard hours allowed for actual production times the standard rate. And what we see over here is that this is going to be the actual amount, and this amount over here is actually the amount applied to production, or allocated to production. So the actual number of hours were 162 direct labor hours times the actual rate, which I don't think was provided. But we can look at our income statement. Here's the income statement, and we find that the actual cost for the variable manufacturing overhead is utilities are $50, and miscellaneous costs are $90. So 50 plus 90, what is that? $140. $140. So the actual variable manufacturing overhead cost is $140. And we could calculate a rate, but it's pretty much useless to do so. So we're just going to go with $140. And then the actual hours are 162 actual hours times the standard rate. Well, let's take a look. Take a look at our standard rate. The variable manufacturing overhead is applied based on direct labors, and the rate per labor hour is 35 cents. 35 cents. So let's multiply our actual hours by the 35 cents. And when we do, we get $56.70. $56.70. So we compare the $140 to the $56.70, and we've got an $83.30 unfavorable variance. $83.30, and it's unfavorable. The reason it's unfavorable is the actual cost is a lot higher than it should have been for working this number of hours. Every hour that is worked, during every hour that's worked, they're going to use electricity and they're going to use those indirect materials. And so if they work more hours, they obviously should use more electricity and they should use more of the indirect material. So we're trying to figure out, based on the actual hours worked, 162, how much should the variable manufacturing overhead cost have been? Well, at our standard of 35 cents per hour, it should have been $56.70. Instead, it's $140. So we're not sure why that is, whether they're leaving their lights on at night, or they're just using too much or wasting too much of their indirect material, or perhaps they're including some other costs in here they shouldn't be including. But there is a problem, and we've got an $83.30 unfavorable variance. So when we think back and we say, hey, why is this income so low? Part of it is because we've spent too much. We've spent too much on variable manufacturing overhead. So this variance is often called the variable manufacturing overhead price variance. And another popular name is the spending variance. So the spending variance. You wonder why somebody might call it a spending variance. Well, the reason they might call it a spending variance, let's say that this entire variance was caused because of paper towels. You know, they spent too much on their paper towels. It could be that they spent too much on paper towels because they used too many rolls of paper towels, right? They were not efficient as they used the paper towels. Or it could be that they spent too much on their paper towels because they paid too much per roll of paper towels. They bought them at the convenience store instead of the, big box wholesale store. And so we don't know why they spent more on their paper towels, but they did. We don't know if it's because of they used too many rolls, or the price that was paid was too high, but we can say this: they spent too much. So that's why it's sometimes called a spending variance. But then other authors call it a price variance, So it depends on the textbook that you're reading. So now let's move on to the next variance, which has to do with this 162 hours that they worked. They worked 162 hours. And while they're there working 162 hours, they're not just getting paid their $10 per hour. They're also using electricity. They're using glue. They're using all of the variable manufacturing overhead resources. The longer they're there, the more resources they're using. Now, how much are they using? Looks like they use about 35 cents per hour worth of these resources. So if they work longer than they should, then they're going to consume more overhead resources. So the inefficiency of our labor force, or the allocation base, will actually cause the amount we spend on the variable overhead to go up. So now let's take a look at how much they should have worked. Well, they should have worked, let's see, they've got the actual quantity of mailboxes produced, the actual production of 225 times the 0.6 of an hour per mailbox. And then we're going to multiply this by the standard rate of 0.35. So 225 mailboxes times the 0.6 of an hour, they should have only worked 135 hours. That's all they should have worked. And if they did, they would have used, of course, variable manufacturing overhead in the amount of $47.25. So this is the amount they should have spent on variable manufacturing overhead based on the number of hours they should have worked. But oh no, they worked 162 hours. They worked a lot of extra hours. And during those hours, they were using up variable manufacturing overhead resources. So how much? Let's take a look. Because they worked too long, it's $9.45 unfavorable. And this would be the variable manufacturing overhead efficiency variance. And you might think it measures the efficiency with which they used variable manufacturing overhead resources, but it doesn't. It's an alternate measure of the efficiency of the allocation base. In this case, the efficiency of our workforce, and that they weren't very efficient. They worked too many hours, and because they worked more hours, they used up more variable manufacturing overhead. It's not very much money in this case because the rate is at 35 cents per hour is very low, but that's what happened with their variable manufacturing overhead. They were there working too long, so they were using up variable manufacturing overhead resources, and somehow, based on the number of hours they did work, they used a huge amount more of variable manufacturing overhead resources than they should have. Another variance that could be helpful for variable manufacturing overhead is the total variance, and it's the difference between the actual variable manufacturing overhead and the amount applied to production. So if we compare those two amounts, in this case, it's $92.75 unfavorable. Another way of arriving at the same amount is to add the two variable manufacturing overhead variances together. You can add the variable manufacturing overhead price variance of $83.30 and the variable manufacturing overhead efficiency variance of $9.45, and you'll arrive at $92.75. This variance is also called the variable manufacturing overhead flexible budget variance, or it could be called the variable manufacturing overhead spending variance. Here's a neater presentation of the same variances. So next we're going to calculate the fixed manufacturing overhead variances. And before I begin, let me just say that the calculation for the fixed overhead variances are quite different than the ones for variable overhead, direct labor, or direct material. These variances differ in that what we're going to do is we're going to compare the actual fixed manufacturing overhead cost to the budgeted fixed manufacturing overhead cost. We're going to compare that to the fixed manufacturing overhead allocated or applied to production. So allocated or applied to production. So on this end, way over here, we've been using actual hours times the actual rate. And way over here at this end, we've been using standard hours allowed for actual production times the standard rate. And the ends are the same. Those at the end are the same. The part that's different is the amount in the middle here, the budgeted fixed manufacturing overhead. To get this budgeted fixed manufacturing overhead, what we have to do is take budgeted production in units times the direct labor efficiency standard times the fixed manufacturing overhead standard rate. Sort of blending over there, but you see what it is. So budgeted production, if you'll recall, was 300 units times the direct labor efficiency standard, which is 0.6 of an hour, times the fixed manufacturing overhead standard rate, which is $1.25 per direct labor hour. And so multiplying this out, what happens is, let's see, we get $225. Let's see, we've got the 300 times 0.6. That gives us 180 direct labor hours that we budgeted, times the $1.25 times 1.25, $225. So the budgeted fixed manufacturing overhead is $225. And we compare that to the actual fixed manufacturing overhead. Let's take a look. Here's the fixed cost November statement. We've got the rent of $300, depreciation of $35. So it's $235 total fixed cost, $235. So it is $235. And you could get, the actual hours, which are 162, times the actual rate, which they don't provide, and we don't need actually, but we do know that the actual cost for the manufacturing overhead was $235. So we compare the $235 to the budgeted amount of manufacturing overhead, $225, and we get a difference of $10. $10. And let's see, is it favorable or unfavorable? Well, on the actual side, it's higher, so this is going to be unfavorable. And this is the fixed manufacturing overhead, sometimes called the spending variance. Very often called the budget variance. And it's called the budget variance because more often than not, the problem with this, and the reason you got a variance, is not because a manager was unable to control their cost. It's hard to control fixed cost once the year begins. How are you going to control your rent cost once you've signed the lease, or your insurance cost once you've signed up for the policy? So fixed manufacturing overhead costs are difficult to control during the period. Instead, these variances are often caused because the budget wasn't quite right. So sometimes they're called spending variances, sometimes they're called budget variances. I've even seen them referred to as price variance. Price variance. My favorite is, of course, budget variance. I think that these variances are very often related to the budget. So now let's compare the amount that we budgeted to the amount applied to production. Now what happened here was we produced, instead of 300 units, we only produced 225 units, times the 0.6 of an hour per unit, times the $1.25, which is the fixed manufacturing overhead standard rate. So 225 times 0.6 is 135, times the $1.25, and multiplying that gives us 168.75, 168.75. And now we're going to compare these two amounts, and what we get is a difference of 56.25, 56.25. Now don't try to figure out if it's favorable or unfavorable just yet. Before you do, I want to point out to you that the difference between these two sides is this. The budget side is for the number of units we budgeted to produce. On this side, the amount applied to production, it's the number of units we actually produced. So number of units that we budgeted, number of units that we actually produced. How did we do? We budgeted to produce 300 units. We only did 225. Did we do okay? I think most of us would say we didn't do too well. We underproduced by like 75 units. Now remember that equipment that they bought? Remember the equipment they bought to make these mailboxes? They bought some pretty, substantial equipment. It was $900. And they bought that good equipment because they were going to make a lot of mailboxes. And so they have this production capacity available to make these mailboxes. And they rented a garage. Production capacity to make the mailboxes. They actually underproduced by 75 mailboxes. And you could say that they wasted some of their investment in fixed manufacturing overhead, because the fixed manufacturing overhead gives them the capacity to produce. They've wasted some of that capacity because they clearly underproduced. They produced far fewer units than they should have. And then you say, well, so what? So what? Well, how much did that unutilized capacity cost them? How much did it cost? That underutilized plant capacity for the 75 units that they didn't produce cost them $56.25. They wasted fixed manufacturing overhead capacity in the amount of $56.25 because they underproduced these units. And you can figure it out. 75 units times, we could just multiply by the fixed manufacturing overhead per unit, but that's not how we do it here because it's allocated based on direct labor hours. So 75 units times 0.6 hours times the $1.25. So the 75 units, let's see, 75 units here, 75 times 0.6 is 45 direct labor hours times the $1.25 times 1.25. And we get $56.25 associated with this underproduction. So really, this variance has to do with the underutilization of their plant capacity. And what it's called is the fixed manufacturing overhead production volume variance. Fixed manufacturing overhead production volume variance. Sometimes just called the volume variance, fixed manufacturing overhead volume variance of 56.25. Now that we've gone through this, now what do you say? Is it favorable or unfavorable? Well, they underproduced, so it is unfavorable. Before we talked about it, you might have said, oh, that looks favorable to me. But now that you find out what this variance is for, then you look at it and say, no, that's definitely unfavorable. We underproduced, and therefore it is an unfavorable variance. It's also probably worth noting that the spending variance or budget variance is the fixed manufacturing overhead flexible budget variance. Because the production volume variance is a volume variance, it is not part of the flexible budget variances. So here are the fixed manufacturing overhead variances, neatened up a little bit. Now, all the variances we've done, except this one, all of them have been flexible budget variances, what are called flexible budget variances. And this one is a volume variance. It's a volume variance. Now, I know this is beyond the scope of what we're covering here, but just in case you're looking at this video as part of your studies in a cost accounting class and they're getting into sales volume variances and flexible budget variances, all the standard cost variances that we've calculated, of all 8 of them we've calculated, this is the only one that is a volume variance. The rest of them are all flexible budget variances. So if we want to know something about how badly the company did here, they did badly. The only variance that was favorable was the direct material price variance. After that, all the other variances are unfavorable. And I've totaled the first 7 to arrive at the flexible budget variances of 505.50. And then adding in the final variance here, the fixed manufacturing overhead production volume variance, we get a total variance amount of 561.75. So if they were able to control their use of their resources better and control the costs of these resources, their profits would have been higher. And part of the reason for their low profit is that they sold 75 units fewer than they thought they were going to sell. And that would explain some of the difference. Another thing that would explain it are these variances here, which based on their production of 225 units, they could have had profits that were higher at least by $505.50. So this brings us to the end of our video. Thank you for tuning in, and if you found this video helpful, please give it a thumbs up. So this is Mike Werner from Miami saying bye for now, and I'll see you in the next video.